Hey everyone, welcome to this tutorial on the difference between active and passive investing. In this quick tutorial, I'm going to explain the two different terms and what you can look for when you're deciding which one is best for you. So firstly, what is active and passive investing? Well, to explain the concepts, I think it's good to use an example. So when we talk about active investing, as the name implies, what we're talking about is being more, I suppose, motivated to make change in your portfolio or in your investments. So some of the types of active investments are stock picking, so picking individual stocks on the stock market. The other is trading, so you often hear people call themselves traders, or they're talking about, you'll see on the TV, you'll see people saying that we're trading this stock during the day or gold or whatever. It could be anything that they're trading to make money. That's a very active strategy because every day you are making changes to the portfolio. Another different type of active investing that you could do is funds or ETFs. So you could be picking individual funds or managed funds that you think are going to do well and selling or getting out of those that you think are going to do poorly. Same thing with ETFs. So a common question I get is, are ETFs active or are they passive? And the answer to that question is it depends, because ETFs can do both. They can have a strategy that is active, or another ETF could have a strategy that is passive. So what do we mean by passive? Passive strategies traditionally have been known as index funds. So when someone says that they invest in index funds, it's pretty much the same thing as saying that they're passive investors. So it's important to understand here that there are different types of passive investing and there are different types of active investing, and it's not black or white. There's a continuum. There's, shades of passive and there's shades of active depending on how you go about things. So as I said, the most common type of passive investing is index funds. So what is an index fund? I've explained this in a couple of other videos that we have on the Rask Finance website, but quickly, what an index fund is, it just follows whatever is in the index. So a fund might say, we follow in Australia, the ASX 200 index, which includes 200 companies. So the index fund will go out and buy all 200 companies in the index, and it will do that every so often. And then when you invest your money, what you're getting is exposure to all 200 companies. And all it does is follow those 200 companies. If one of the companies falls out of the index, it will sell that. If a new one comes in, it will buy that. And in a moment, I'll show you how that looks on a graph. So the ways that you can invest passively, you might do it through your superannuation fund or a pension fund, for example, or you can do it in your own name, just like you would with shares or picking your own individual funds and ETFs. So what I mean by in your own name is you could go out and you could approach a fund manager that does this type of investing, and you could fill out the PDS, or you could go online and you could invest with them online by depositing your money into one of their funds. And of course, you'll pay fees for both of these, which we'll get to in just a moment. So how about performance? I've got something on the other side of the whiteboard I'd like to show you. Okay, so as you can see, on this side of the whiteboard, we have a graph, and it's just a standard stock market graph that you would see anywhere. What's important to note is that there are three different lines. There's the green line, which is what we call the market. So let's say, for example, again, that it's the ASX 200 stock market index. You'll see this on the news every day. Over time, and this could be many years, for example, this could be a decade, you'll see that the green line will go up, it will go down, it will move sideways, but it's pretty unpredictable by the looks of this chart, right? There's times when it comes down and there's times when it rebounds really well. What an index fund does, as we know, it buys into the companies that are in the index. So you would expect it to look round about the same, right? Like you would expect the performance of the index and the fund to be very close. So as you can see in this chart with the blue line here, the blue line very closely hugs the green line, which is the market or the ASX 200. But you'll notice that it's slightly off, it's slightly different. And the reason for that is fees, or it could be the implementation. So when a company enters or exits the index, the fund itself may take a bit of time to get that new company in and out in the right weighting. And this is what we call tracking error. So when you're looking at a passive investment, if you really wanted to get into the nitty-gritty details, you could look at the index fund's tracking error, and the lower means better. So a lower number means better. Now, what does an active fund look like, or what does an active strategy look like on the chart? Well, it depends. I mean, you could be a really good active investor and you could pick individual shares that go to the moon and you do really well and you retire in 3 years, but the chances of that happening are very unlikely. If you look at a professional active investors fund, so a fund manager that invests actively, maybe picking his or her own stocks or bonds or properties or what have you, the performance will deviate from the market. So you will see an index fund or the market, which is the blue and green lines here, you will see that the red line deviates significantly. So during times, for example, this little period here, and we'll zoom in right here, is you can see that the two lines, the green line and the blue line, go down, but the red line continues up. So active investors try to outperform in all markets typically. So they try and outperform when the market falls, or they try and do better when it rises. But different types of active investing would do better at different times. So that's why when we say, don't judge an active investor by 1 year's performance or the last month or the last week, you want to look at it over many years. For example, let's say that you had invested in the active fund right back here in the beginning, and then you get to here and you think, well, I'm going to sell out because the performance has been worse than the market. I should have just invested passively. But then say if this is a 2-year period, you can see here that the red line comes way back up, and you would have been silly for selling down here because it's gone up. Obviously, we can't predict the future, but it's important to know what you're investing in before you make a judgment of the performance. We'll switch back over to the other side again. Okay, so we've talked about performance. The next is costs. So what kind of costs can you be up for when you're doing these two types of strategies? So if you're investing in a passive fund or a passive strategy, so you're buying index funds, for example, if you do that through super, the fees could be quite low. In fact, they could be very, very low. If you're doing it in your own name, once again, it doesn't take a lot of know-how. Once these strategies are off and running, it doesn't take a lot of manpower to keep them running. So what you'll find is that the strategies that do these passive strategies in the index funds are actually really low cost. So you can get funds that cost well less than 1% per year in fees, and that's 1% of your total investment. Whereas on the active side, if you go for the same, say you go for a fund or an ETF that does active investing, it might be well over 1%. But what we're seeing is the impact of passive funds are actually having an effect on active funds and driving down the fees, which is good for you and me because that means lower fees, right? For stock picking, you'll also pay fees like if you have a brokerage account and you're paying, say, $10, $20 to buy shares, each individual share, each time you buy or sell, that's going to add up over time, so you have to consider that. And traders obviously are very, very active, so their fees for buying and selling are obviously very high. But then you have things like tax and all the other things that come with that. We've got a lot of content about fees and looking for different fees structures on the Rask Finance website and the different ratios you can use to assess them. So finally, this is probably the reason you clicked on this video, is which is better. Now, many different studies have shown that active investing doesn't do as well as passive investing over a very long period of time. Now, there are exceptions to that rule. So there are some active investors and there's some active professional investors that do quite well over very long periods of time. Typically, when they do very well, they'll retire early and you'll probably have your money returned to you when they close their fund. But if you can find them, it can be a rewarding exercise. Having said that, most active funds do underperform, and one of the big reasons for that is simply fees. If the fees are 1 or 2% a year, that's 1 or 2% more an active fund manager needs to make for you before it would do better than a passive fund that perhaps charges less than 0.5%. So there are some things that you can consider, and there's many studies. I could pick out one study that says this one's better than that one and vice versa. But if you are inclined to invest actively, I think there are 3 key ingredients that you need. Now, the first one is you need time. You need time to research, to learn, to read books, to listen to podcasts, to read blogs, to maybe even do a short course or an extended course at university. You really need that time to focus on your investing, because if you don't, if you're a do-it-yourself investor and you don't have time to I suppose put in the effort to learn or get advice from a professional, then it could lead to a very bad outcome. Curiosity. One thing that hit me when I was young was that I loved learning about business and about investing, about finance. And I see that in a lot of the people that I interact with daily. It's not necessarily about making money, it's also about learning and understanding how the world works. So curiosity is another important ingredient, I think, to be successful. The final one is temperament. If you're the type of person that wants to get rich quick, investing is probably not the right thing for you, because you're going to find that there are times when you do very badly. And when I say times, it could be weeks, it could be months, it could be even years that you do very poorly in terms of your returns. And if you're the type of person that hasn't put in the effort to understand your investments and might sell out at those inopportune times, that's not a good that's not a good recipe. So you don't want to be a person that I suppose has emotions that are just flying all over the place, and you're investing because you need to get rich, or you need your money to grow so you can do X, Y, Z. That's not a good thing. You don't want to be put in a position where your money's at risk in investments like shares or even bonds perhaps, or property, and you have to sell for the wrong reasons. And now the final thing that I want to touch on here, and this is super important, is that you don't have to choose which one you want to do. You can make your own mind up, or you can use both, right? You can, for example, you can use a core satellite investment approach, and I'm just flipping the board over here again to show you one last thing. So let's imagine that this pie chart is your total investments. So all of your investments are in a portfolio that you can chop and change. You can invest it where you like. There's a common technique that we call a core satellite investment strategy. And what it is you have this core of defensive, strong investments that make up the bulk of your portfolio. So say if this is 100% being a pie chart, you can see here that the blue section would be passive investments. This is just an example. You could invest 75% of your money, or 75 to 80% of your money, in passive investments. And then you could take a satellite approach, or have a small amount of money in more active strategies. So you could say, okay, I admit that I'm not the best investor, but I'm willing to invest passively. But I also think that this guy or girl that I spoke to the other day actually knows what they're talking about, and I think that they're going to do well over a very long period of time. So let's invest with them, or let's buy some individual shares. I heard this trend is doing really well, so let's use that amount of money to invest. So if you had $100,000, this would be $80,000, and that would be $20,000. Another great way to think about this is to start when you're a beginner, because that's when you probably make most of your mistakes. They're your least costly mistakes typically if you have a small amount of money, but that's when you make more of them. So what you can do is you can start with a passive portfolio. So for example, you could start by investing in index funds, knowing that you're not always going to see really good returns, but you'll see returns that are respectable. And over the long term, they're typically going to do really well. So you stay the course. And then over time, say you learn more, you read more, you might say invest a 10 minutes or 20 minutes or an hour a day to learning about investing. And then over time you think, okay, my portfolio is at 20 grand, it's at 30, it's at 50, it's at 100, I've done really well, it's at 500, who knows? And then over time you think, okay, I've done quite well out of this, why don't I try my own hand at picking individual shares or picking individual funds, or giving your money to an active investor and seeing how they go for you. Because then you don't have as much to lose relative to the total wealth that you have, but you've gone into the market, making all the right decisions, being conservative at first, and then taking on more risk over time. And that's just one strategy you could go with. Everyone's risk profile is different, everyone's means are different, everyone has different amounts of income and long-term goals, etc. So this is just a simple way I think about it, and this type of portfolio could be set up in a matter of hours or days. You could start investing into passive investments, and then over time, maybe over years or weeks or months, you start investing in more active positions. But you can start this way. It's a really good way to do it. Anyway, I've waffled on enough for this video. So this is active versus passive investing. If you have any questions, as always, please head to the Rask Finance website. We've got loads more videos just like this one. And cheers to our financial futures.